Hello and welcome back to The Note, coming to you from London again this week. Now the question for today is the infrastructure gap. Across the world there is an intense need for better infrastructure. There is also an intense desire by institutional investors to invest in something that looks a lot like infrastructure. Why, therefore, is there a gap? Why is it as difficult as it is to raise funds for infrastructure? Now let's illustrate the problem. Let's start by taking a look at the US. As you can see, infrastructure spending in the US was very much higher as a proportion of GDP back in the 50s under Eisenhower when he built the interstate highway network. It also rose intriguingly under Ronald Reagan, and you can see it rose to a much lower peak briefly during President Obama's stimulus at the beginning of his term. But broadly, infrastructure spending is far lower than it used to be, and that has led to many very embarrassing examples of poor infrastructure around the US, perhaps the most notorious example being LaGuardia Airport, which Vice President Biden describes as being a third world facility, and where there is now an attempt to finance a very ambitious retooling. Beyond that need for infrastructure, however, you can also see when you take a look at the investments that are being made by investors that the amount of money going into the sector from big pension funds, endowments and so on is rising very significantly. If you survey big institutions, they will almost invariably say they want to invest more in infrastructure, and that makes sense. You find it almost impossible to get money from something like bonds at the moment with interest rates so low. Real assets give you some sense of security. It's a classic investment that makes sense for long-term investors, particularly now that real estate looks as though it is getting too expensive. And yet, if we now take a look at the gap between infrastructure needs over the next 15 years and projected infrastructure spending, you can see that it's critical. These numbers come from McKinsey, but various other estimates tell you much the same thing. We're looking at a gap of some $20 trillion in investment spending on infrastructure, and that covers all categories of infrastructure, most blatantly roads. Now, what is the problem? The government level, there is always an issue, particularly in the emerging world, of asking people to pay something for a service they previously regarded as public. It's a very tricky issue to start paying, charging people for something that was once free. You also have the issue that you've got to get that pricing right, or otherwise people simply won't use it. Perhaps a notorious example was one of the first big attempts to raise emerging market infrastructure spending in Mexico 25 years ago. They set the price for their toll roads too high, and eventually very few people used them, and the toll roads defaulted. Perhaps most significantly, there is simple, straightforward political risk. The average infrastructure project has to last much longer than the average government in a democratic country. That leads to the issues that deter the private sector from investing. They don't want to take that political risk, particularly when it comes to emerging markets. They don't want to take country risk. If you have a revolution, that means that your long-term technocratic infrastructure project is unlikely to get funded for much longer. But perhaps the most important issue is that all of the money for an infrastructure project has to come up front, and the income from it only comes much later. That means that projects have to be very well worked out indeed, leave no question in the institution's mind that this can be done before they're prepared to invest in it. At the moment, there is such a critical need for infrastructure across the world that governments have a huge laundry list of projects they would like to do, and haven't, as far as the private sector is concerned, done the work to prove that any individual plans, any priorities, can actually be turned into money-making long-term investments. Now, there are many different approaches being taken to trying to deal with this gap, which I've detailed in a piece for the paper. Perhaps the most interesting is that some pension funds are deciding to just set up their own infrastructure subsidiaries and do everything themselves without government guarantees. The government will tell them they want to do a transit line somewhere, and then it will be the pension fund itself that not only builds it, but then owns it and operates it and takes in the income from it. That's an aggressive approach, but it might be necessary because as it stands at the moment, this gap in infrastructure spending is a very serious problem for developments across the world, and there plainly is a very great need in the private sector to invest in it.